And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Thursday, second best day of the week. Getting ready to wrap up this middle of October and going into the last 2 weeks of the month. Of course, lots of earnings coming out. We've got earnings rolling out today, but next week we get into a big bulk of the earnings. So it's going to be a very heavy earnings week. Netflix, others next week. Over the next 2 weeks in particular, so next week and then the last week of October, you're going to have about 80% of the companies will have reported earnings. So the next 2 weeks, so while we're getting quite a few earnings today and tomorrow, next week earnings gets really, really busy. But so far, so good. After having lowered estimates coming into the quarter by about $10 a share, companies are beating estimates, and it's great. We came into earnings season a little bit under expectations in terms of Wall Street after the Liberation Day. I've actually got a graph I'm posting in this weekend's newsletter, but you can see that when Trump announced those tariffs, there was a very, very sharp drop in earnings per share estimates for this quarter. Then those quickly rebounded as soon as we got, kind of some resolution on the tariffs, but they never got back to where they were, and then they drifted slightly lower since. So despite, this kind of upheaval in outlooks because of what tariffs were going to do, although nothing ever became of the tariffs, it did lower earnings expectations. So again, we're having a good beat rate. By the time we get through the end of this quarter, we're probably going to have a 75 to 80% beat rate, about average, about usual. Companies will do okay. So again, I wouldn't bet a whole lot right now against earnings season here for the next couple of weeks. We could have some market volatility for sure. There's certainly some companies that come in that miss expectations, but it's not going to be so much the earnings miss that's going to matter. It's going to be the outlook, and particularly when we start getting into next week. So right now we're doing banks for the most part, but next week we're going to start getting into kind of the Mag 7, those type companies, the Netflixes of the world. And so their outlook for, what it's going to look like in the fourth quarter and into next year is going to be much more important than the numbers that they just, kind of report. And again, this is particularly the case for the AI-related companies. We did see a lot of good reports coming out in the second quarter from the AI companies, lots of expectations about, build out for CapEx, et cetera. So again, they've kind of set the bar high for themselves going into this reporting season. So these companies are going to have to really come out and say, oh, not only were we going to build this many, we're going to build this many now, whatever it is. But, they've set the bar fairly high. So there is some room for some disappointment in kind of the Mag 7 just from the buildup of expectations that we've had. So, again, just something to be aware of. While this market will likely end higher by the end of the year from where we are now, doesn't mean it's going to go there in a straight line. So there's going to be some potential risk here as we get into November and into December for some potential, at least short-term drawdowns. That will probably be met by the dip crowd, just as we've seen here lately. But again, expect some volatility between now and year end, particularly in the first 2 weeks of December when mutual funds do all their distributions for the year. So again, we typically get some weakness there as well. But all those will be opportunities, and this is really kind of the subject for this weekend's newsletter. It's talking about kind of the 3 reasons for the market being higher by year end. And again, doesn't mean we're not going to get there with some volatility, but there's a lot of things to kind of propel markets higher. Buybacks are going to be very large here over the course of the next 2 months as we get into year end as well. So there'll be about $7 billion a day in buybacks, just kind of pushing market prices higher across the board. Okay, so having kind of touched on that, again, we're still lacking economic data. We're still in the middle of the shutdown, so that hasn't resolved anything, so we don't have a lot to touch on economically speaking. There are a few reports that we're going to get out from different pieces, kind of different areas of the market, But again, all the government reports right now are still shut down, and so we won't get the only report we're going to get is on the 24th, which is CPI. So for right now, markets are kind of just running on momentum and a lot of exuberance, and there's a lot of that right now. So here's what you need to know before the bell this morning. So we talked about here over the last day or so about, we had this crack on Friday. Markets kind of retested the 50-day moving average twice. Yesterday, the markets actually had a nice open yesterday, but then sold off, actually went negative about midday, and then actually rallied back into basically mildly positive territory by the end of the day, but not by much. It was a very weak day overall, but the good news, so kind of a good news, bad news situation. Good news is markets did reclaim the 20-day moving average, so that's good from the standpoint that you're kind of negating that break of the 20-day moving average. So the kind of the buy the dipper stepped in. Every time we hit the 50-day, they stepped in, bought stocks, pushed the prices up. We failed the first test of the 20-day moving average, but did get above it on the second test yesterday. So that's the good news. As I said, it's kind of a good news, bad news thing, only because it was a very weak day. Volume-wise was not great. Action in the market was not great yesterday. Fairly narrow across the board in terms of breadth. We are starting to see a rollover in breadth. The 50-day, 200-day moving stocks above their 50 and 200-day moving averages are rolling over. So we're seeing some weakness kind of infiltrate into the market. So again, as I said, it's good technically that we got above the 20-day moving average, but we didn't really do it with a lot of conviction. Markets are pointing higher this morning, so we may get some follow through today. That would help if we can maintain that today. Again, what we've seen though lately is that we do see the markets open higher and then immediately sell off within the first couple of hours. So again, we're looking to open up about 20 points or so on the S&P. We'll see if that can carry through this morning. Or if we have another day where we open up and immediately sell off again, and that's kind of been the case so far. But again, technically, there's nothing wrong with the markets, and this kind of consolidation has been good from the standpoint that we did work off some of that overbought condition, but we are still on a MACD sell signal right now. So again, just from a momentum basis, there is some weakness here. So again, just be a little bit cautious with your risk taking here. There's kind of some opportunities that may be presenting themselves, and it's okay to take advantage of that, take advantage of this little pullback, this little spat of weakness we're having, take advantage of that to put some money to work, but just do so with a little bit of mind towards risk, just because until we can reverse that momentum signal back into a buy, there is some potential risk for further kind of either corrective or consolidative action here at, kind of currently right now. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk a little bit about capitalism, markets, QT. Got a lot of stuff to get into today on today's edition of the Think Tank, so go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Is that royalty-free music?
Yes, it is.
That certainly sounds very familiar as a very, very familiar tune.
Yes, it does.
Now, I'm not going to call out the name because I don't want Google to pick up on it and go, oh, you're playing royalty music.
Man, welcome to my world behind the scenes.
So,
yeah, it's all royalty-free music.
Google.
YouTube.
Exactly.
Good grief.
But that does have a bit of the flair.
Yes, a bit of a bite.
Exactly. I like it. I like it a lot.
Man, we do that on purpose.
I know. It's all good. But yeah, I miss the days we could actually play royalty music. So
you mean real rock and roll?
Yeah, real rock and roll back in the day.
Leonard Skinner.
Exactly.
Zeppelin.
Yeah. Those are the...
Stick around after the show. I'll boot some up.
There you go. We'll have to start streaming on some other channel. There are other channels. There are other platforms.
Well,
like
we're on 3 of them already.
Well, yeah, but Kick and Twitch will allow you to actually stream.
Oh, really?
Yeah.
I'm getting the itch right now to Twitch.
There you go. All right. Got a few things to get into this morning. First of all, Michael Lebowitz joining this morning as always. Mike, welcome to the show.
Thank you. Good to be here.
Good. So a couple of things I wanted to touch on this morning just real quick, and then we'll talk a little bit about your article on capitalism as well. But, it's kind of interesting that, you and I have talked about for a while that, the Federal Reserve was still doing quantitative tightening and that it was kind of just a function of time until they started talking about removing the QT process. And we got the first kind of hint of that this week from Jerome Powell. Again, it's really not a major deal. Markets did like the news initially. But we were doing $25 billion a month in QT. We had dropped that previously to just $5 billion a month. So it's not the QT process is not that big of a process right now, but it was still reducing the balance sheet somewhat. But now the Fed's talking about potentially reducing that to zero. Doesn't mean we're going back to QE yet, but it does kind of set the first stage. It does kind of set the stage for the next step being a move back to quantitative easing should something kind of go awry economically speaking.
And Lance, when you say $5 billion is what they're doing now, they're also doing mortgages.
Right.
So it's a total of $40 billion that they're doing. And yes, mortgages are not treasuries, but it's bonds that have to be absorbed by the market. Mm-hmm. So that's $40 billion of free reserves that can be used to buy other securities by Wall Street, that can be used for investment purposes, to make loans, for whatever it is. So the net impact to the bond market is, or generally to the bond market, but to the loan market and investment markets is about $40 billion. So it's not a huge deal, but it is something, and it should ease some of the pressure on the Treasury debt issuance that's going on. And we talked about this, I think it was March, April. Mm-hmm. We were kind of out there saying, don't be surprised if the Fed says something about QT, if they start reducing QT. And we were a couple months ahead, and we knew we were a little bit ahead of the ball, but we knew that the overnight repo program, which is where all the excess reserves liquidity lives, was dwindling down to zero. Now it is close to zero. And every once in a while, we see some funding problems in the overnight markets. Mm-hmm. And the overnight markets is the engine for the big freight ship that is all the other markets. When those engines get stuck, when they stop working, everything stops working. We saw this in 2019. We've seen it during the crises. When the overnight markets stop working and companies can't fund themselves properly, investors can't fund themselves, the engine seizes up. So I think the Fed learned a lesson in 2019. Don't let liquidity problems get too far ahead of themselves. Now they're trying to stay ahead of it. So
right, and we did kind of see recently, and it wasn't significant, but we did actually see a bit of uptick in the overnight lending rates, a little bit of kind of I don't want to say a seizing of the engines, so to speak, because that's not really what happened. But you did see an uptick in reverse repo, et cetera, very similar to what we saw, in a very minor scale back in 2019. And then it was interesting that as that's happening, the Fed's talking about dropping QT. So are they starting to see potentially some bit of risk in that overnight funding?
Potentially. And, I think they're driving a car, and a car every once in a while will just sputter. It'll miss a cylinder, miss a spark. And it's not noticeable to the guy in the back seat, but the driver feels it every once in a while, mm-hmm. and notices that there's just something not perfect. There's no more extra liquidity. So you do expect these little problems to arise. And I think the Fed's probably being a little overly cautious. But, last Friday, what happened in the Bitcoin cryptocurrency market tells you that liquidity can be lacking. Mm-hmm. Now, it showed up in one of the most, at 5 PM on a Friday, in the altcoin crypto market, which is not the most liquid market to begin with. So we got to be careful drawing conclusions. But liquidity is liquidity. And, that may be, in hindsight, a little sign that there's something going on. But no, I don't think it's a big problem, but it does mean that now we have to watch the overnight repo markets and the overnight SOFR markets and see how all these overnight markets trade in comparison to each other for clues that something is amiss.
Yeah, and look, the markets have been, the markets overall have been, just kind of running in hyperdrive as of late. Everybody's very excited. It really doesn't matter what asset class you're in. You're making money no matter kind of where you put money. It's making money right now, which is, that's a very easy market to be in, but that's also a market that generates a lot of risk in it. And again, when you have this kind of one-sided market across all asset classes and you get these correlations moving a lot closer to one, that typically sets up that potential for that unexpected reversion, and whatever causes it. And, we've seen this repeatedly throughout history. In 2019 is a good example. Markets were just taking off. Everything was doing great. And then everything buckled in 2020. And of course, there's things that happen, and, nobody knew that we were going to shut down the economy in 2020, but going into that, there was other indications. You and I were writing articles about what was happening in the reverse repo markets and those type of things. We're talking about liquidity issues here on the show, and we started reducing risk in portfolios because you were seeing some of that impact across markets. Even before you got into March of 2020, and so we had already started taking an advantage of what the data was telling us. And then this event shows up. And that's always the issue, is that we never know what that event is. But markets, when they get kind of in a structural problem, and when you have an environment where, like today, where you have so many asset classes moving and closer to a one in terms of correlation, you see money just kind of chasing price for whatever reason. Not really paying attention to fundamentals or values. It's just, hey, markets are going up, I got to be in. That creates fragility in the markets. And then that fragility only requires a very small disruption to lead to a fairly market downturn across a variety of asset classes all at once. Maybe Bitcoin was a one-off last Friday. Maybe that's just kind of maybe that's kind of just the warning bell that there's some fragility that's becoming broader across markets.
And Lance, what I learned last Friday is that so many of those coins, Fartcoin, Dogecoin, coins I've never heard of, Atom, IOXTE or something like that. I mean, there are hundreds of them. Investors are using significant amounts of margin to buy those things. And that's one trait that those altcoins have that is rampant throughout the market. Margin use, basically borrowing money to buy stocks, bonds, you name the crypto, you name the asset, gold, silver, it is happening, and it's rampant. It seems like I keep seeing this, but there's these new issues or proposed issues of ETFs that are 2 to 3 times levered on individual stock names. So I saw some company came out a few days ago, 17 or 27, like AMD, NVIDIA, 2-3 times levered. So basically you can buy those stocks on leverage. Even though it's an ETF, it's easy for you. You're not the one really borrowing the money, but someone is. And, we just see it across the board. So liquidity is very important to where this market is. And I would say most importantly to those things that are going up the most right now. So, if you're in gold and you think you own this nice, safe asset, bear in mind that many other people own it on margin. And if they get a margin call, they have to sell. There was forced selling of altcoins at a penny that were trading at $2, $3, $5, $10 prior to that. So, you can own, the asset itself doesn't matter. What can matter in times of liquidity crisis is how much that price is dependent on liquidity, and can investors get liquidity.
Right. And again, there's nothing wrong with leverage, and there's nothing wrong with those type of things. Leverage is what makes markets go up. And we talk a lot about margin debt. Margin debt is well above $1 trillion now. First time ever we've had that kind of level of margin debt within the overall markets. But of course, markets are also bigger as well, so that just grows over time. but margin adds buying power. So to Mike's point, the more leverage you have, the more buying power you have. So that drives asset prices higher and further than a lot of times logic would even say. It's like, this is, we're in bubble territory for stocks. The thing about bubbles is they're only recognizable in hindsight, because bubbles can take a very long time to form and they can last a lot longer than you think because of leverage. And you can leverage that market higher. I mean, eventually people run out of cash to buy stuff. And when they run out of cash, they've got to go to leverage. And we're seeing a lot of leverage across markets right now. And the impact of that is that when things reverse, leverage works worse in reverse. And what I mean by that is that while leverage can help things go up, a leverage also causes things to go down much more rapidly than you can possibly imagine. There was a really interesting story out on, I think, Monday or Tuesday of this week. Granite Shares, which is this company that issues ETFs, had a 3-for-1 leverage short on AMD. And there was an ETF you could buy. It was a 3 times leverage AMD short. The holders of that ETF got a notice earlier this week that the value of that ETF was now 0.0000. It went out to 4 digits. And that was because of that announcement between AMD and OpenAI that caused the stock to surge like 25% in a day or 30% in a day, completely wiped out the ETF and the value of that ETF because of the leverage. And that's my point, is that be careful. If you're on leverage, be careful of what you're investing in on leverage. It sounds great when things are going up, but all it takes is a very small break in the market to basically wipe you out because of the way options work in those strategies. But then also be careful of the fact that understanding that a lot of this market is being driven by leverage, which again is okay because that leverage supports the bull market. Just understand that when something breaks, and something will break at some point, all these assets that are all going up at the same time, something will happen and there will be a break. It'll just be a change of sentiment. One morning you're going to wake up and you're not going to know any reason why. There won't be any major news headline, but all of a sudden the market's going to be down 3 or 5%. And the media will come up with a reason for why it's down 3 or 5% in a day. But that'll be your first signal that somebody has raised their hand on Wall Street and said, hey, I'm out. And once that happens, it starts to kind of spread across markets, and it spreads very quickly. And that's how you have these bigger corrections in markets. And they will happen faster today than they've happened historically because of so much money chasing, singular assets in a lot of cases, because of the leverage, because of the speed of liquidation that can occur today versus the way it used to work. So just be careful that these markets can have very big corrections very quickly. Doesn't mean it'll happen today, tomorrow, next week. I'm not saying that at all. Just be careful that one morning you're going to get a signal from the markets that something's changed, and don't try to navigate that out. Say, I'm just going to buy the dip, because that dip can be a lot bigger than you think it's going to be.
And Lance, to your point, if you would have told me last Friday at noon, President Trump's gonna get tough with China, he's going to put 100% tariff on China, what's going to be the impact? I said the stock market could get hit. I would have probably said sort of what happened, right? But I would not have told you that crypto would get hit, that Bitcoin would be down 15%, that there would be 19 billion or so of liquidations in cryptocurrency, altcoins, that many altcoins would basically go to zero. So that's an example where the news should not have resulted in that. That the news caused a liquidity problem. Doesn't help that it all happened very late in the afternoon Friday, when Asia is closed, when Europe's closed. They're all on weekend, and for the most part, U.S. traders are checked out. So the point is that we just don't know what will cause a change in the markets, cause a liquidity problem, whatever it may be, and most likely when we look back, it'll be something neither one of us or anyone else really predicted.
So let's, kind of shifting gears again. I don't want to be, entirely bearish on markets, because markets are doing just fine. Again, I don't want people to walk away from this thinking, like Mike and Lance said, the market's about to crash. We're not saying that at all. We're just saying be aware of the risks. There's a lot of optimism, a lot of speculation going on in the markets across asset classes. And again, that just creates market fragility. That's all we're saying. and that it's just a function that you want to pay attention to the risk you're taking in your portfolio. So again, just understand that all assets that go up in price also come down in price. Nothing lasts forever. So just don't forget to manage your risk kind of along the way. And we're just in a very, very bullish environment right now. It doesn't, and we're in one of those environments, and Mike and I have been around long enough. We've seen this numerous times. It's like when you start seeing people tweet stuff, or this market will just never go down. It doesn't matter what happens. This market's just going to keep going up. We've seen these markets numerous times, and we've been in these environments where it just wouldn't seem like the market would quit going up. It would just keep going up every single day. And I'm not talking about 1999. I'm talking about early 2019. We saw the same type of market coming out of 2018. The market just kept going up and up and up. And it's like, we're getting really ahead of ourselves, but, the market's just doing great. And then eventually it corrects. And again, we're not talking about a bear market either. I'm not suggesting we're about to have a 50% decline in the markets. I'm not saying that at all. But I am saying that you could have a 10, 15, 20% correction. That would not be, we just had one back in April, and a lot of people were kind of losing their mind in that one, and having another 10% correction sometime early next year would not be outside the realm of possibility. So just, it's seen, and again, we kind of get in these environments psychologically speaking as well, where it's like, oh, the market's just going up and up and up. It's great. I'm putting all my money into stocks. It's just fantastic. And if I have a 10% correction, that's fine. I'll just buy more. That sounds logical on the surface, but when you get into that 10% correction, and particularly in an environment like this where sentiment is very, very bullish, that 10% correction feels like a 20 or 30% correction. It will feel much worse than it actually is. You will be hit by panic, and you'll be wanting to push that sell button in a lot of cases on assets that you probably shouldn't sell, but it's going to feel that way. So again, this is why navigating risk, Mike and I kind of talk ad nauseum about, take profits, rebalance risk, just doing some, kind of gardening around the edges of your portfolio, because when you get into that environment that you eventually have that correction of whatever magnitude it is, that's where that really pays off, because again, that gives you opportunity. You've raised some capital on the way, so now you've got some money to put to work at better prices. But it also limits that downside volatility to a degree where you can survive the downturn long enough to make good logical decisions about what to do next in your portfolio, rather than making panic-driven mistakes, which is what happens to most investors. Mike?
No, I think you're right. And I think we're kind of in a market where the risks are really two ways. The risk that it can go up a lot more, or the risk that it can fall here. So, if you're going to sit out, you run the risk that it keeps going higher. And if you just think, like you just said, Lance, that the market can't go down, even if it falls a couple percent, you buy that dip and it just goes up to new highs, there's a risk that we get a 10, 15, 20, maybe even more percent drawdown. So just mind your risks. I think it's more important today than at other times. But again, it doesn't mean that risk is to the day. It's like volatility. Mm-hmm. Volatility works both ways, up and down. So just understand and appreciate that both sides of the ledger are in play here.
Right. No, and I was just doing some work yesterday through some different asset classes. There's some asset classes right now that have a 50% drawdown, very easily have a 50% correction, and still be in a bull market. Which, historically speaking, you would go back, a 50% correction, that would be horrible, right? And because this market's gotten so extended in so many different areas, those types of corrections could occur, and you still be in a long-term bullish trend in the markets. And that's something that Mike, you and I have never kind of seen before, where the market is extended as it is. But again, that when you start talking about having a 50% correction and still being in a bullish trend long-term, that's kind of hard to wrap your mind around. But that's kind of where we are dynamically in the markets.
And even scary if some of those markets go into a bearish trend. That's more than 50.
It's more than 50. That'll never happen. Because because as soon as you're probably down, kind of 20%-ish, 25%-ish, how far do you have to get before the Fed steps in, starts doing QE? Then this is what the markets are betting on now, right? Which is that don't worry about market declines. This is the sentiment of the markets that we've created. We were talking about this, I think, on Monday or Tuesday, talking about moral hazard, and that over the last 15 years, every dip has been bailed out by quantitative easing, zero interest rates, whatever it is. And we have now created this moral hazard which is basically guaranteeing insurance against investors. And so investors say, why not take risk in the markets as much as I want? Because if the market does correct, I'm going to get bailed out by the Fed.
True. And the question is, will the insurance company come once again? Will they give it all their money, all their power? And will the market accept it? So far, the answer has been yes, yes, and yes.
Right.
But, we'll see. Fed's been a little bit belligerent over the last year or so, so we'll see. But I have no doubt, like you, that they will try to come to the rescue.
All right, let's talk about your article a little bit that you wrote earlier this week on capitalism, because it's interesting that, again, this is a topic that first of all, I'm very passionate about, because there's so much commentary that's written by ignorant people about how capitalism is broken, capitalism doesn't work. We need to move towards socialism. Socialism would be better. And again, these are mostly written by people that have never left the country. So they've never experienced another society that is in socialism or is in communism. They've never experienced living in those environments. And this is the thing that people don't understand, is that, no system is perfect. Every economic system has its flaws. But there has been no other experiment throughout the history of the entire known universe where an economic system like capitalism has been as successful as it has been. And, we forget that as Americans, and we talk about, living paycheck to paycheck here in the States, and, it's terrible. People don't realize that if you make more than $30,000 a year, you're in the top 1% of income earners worldwide. And that's kind of hard to wrap your head around, but there has been more wealth generated in the United States than basically the entire rest of the world combined. And that's just been a function of that economic experiment called capitalism.
Right. Right. And you know what, Lance, I'm sure this is the same for you. Mm-hmm. When I write articles, sometimes it's a job, sometimes it's a lot of fun. Mm-hmm. This is one of those fun articles that I enjoyed writing, that I was thinking about at night, on weekends, and, what can I do to make it better? And this is, it was a really interesting topic to write about. And my working title on my Word document was actually Quantifying Capitalism, because that's essentially what this article does. It quantifies the benefits of capitalism. And I stumbled across an index, and it's Fraser's Institute's Economic Freedom Index. And what it does is it has 5 components and roughly 65 or so subcomponents to measure economic freedom in, I want to say it was 150 countries, give or take. Things like the size of the government, the legal system, which includes like property rights, which is pretty important, sound money, freedom to trade internationally, and regulations, permits, that sort of things, taxes. So it looks at those for 160 countries, and it gives you an index number ranging from roughly 0 to 9. So what we did was we said, okay, we have this number, and can we compare that to GDP? Can we compare it to income? And that's what we did. And, in order to do that, you need good income data, good GDP data. So we narrowed it down to about 100 countries that we could get reliable data from. The World Bank has reliable data on that. And what you find out when you graph them in a scatter plot, Lance, can you show this?
I'm already are.
Okay, sorry. So what you see is that it's pretty interesting. When the freedom score on the x-axis is between 4 and 7-ish, your GDP per capita, so GDP per person, doesn't really care how much economic freedom you have. Once you get to about 7 and higher, you can see there's a really good correlation. The more economic freedom you have, the more GDP per capita. We did the same, the next graph is income per capita, and I'm not sure you're going to be able to tell the difference. And for what it's worth, the United States is in red in both of these graphs. The graphs look virtually identical. So what that's telling you is that the more economic freedom, the more prosperous a country is. That's great. So we took it a little step further. And again, we're talking, even though we're talking per capita, it doesn't talk about wealth distribution. So what we wanted to see was, well, how does it affect wealth distribution? This is where it gets a little interesting. And, we could probably do some more work on this. But for the United States, for instance, what we did for these countries was the Freedom Index again, and the share of income based on the lowest 20% of the population, the middle 20, and the highest 20. And what you find is in the United States, the lowest and middle 20 are below the average, the top 20 are above the average. And we've talked about that ad nauseum, the wealth gap. And that's what's going on. And that I think does happen with capitalism. Some people are rewarded very generously. A lot of people are making good money.
Well, but there is the rub of capitalism, which is what you just stated, which is capitalism is not an equality system. Socialism wants to try to provide equality across the board. Communism wants to try to provide equality on the board. In reality, that doesn't work. You have a very rich class in socialism, a very rich class in communism, and everybody else is dirt poor. There's no middle class whatsoever. What capitalism has achieved is that if you take advantage of the system and you become a provider of the products, goods, or services in the capitalistic society, you can generate higher levels of wealth. If you're only providing the labor of that capitalistic system, in other words, you're not participating in the system, you're just providing the labor for the system, you're going to be below average. Because again, all you're doing is providing one aspect, which is the labor. But if the advantage of capitalism has always been that if you go out and create the business, if you become the business owner, you create the product, idea, or service, that's where you can. And again, we've heard stories about this all throughout history. The guy that created Paul Mitchell and everything else came to this country with basically no money, had an idea. And then created a business that generated vast amounts of wealth for them. So, the participation in the capitalism has to come from the taking advantage of the system, not just providing the labor for it.
Correct. So, the next thing I did was I said, okay, we have these 5 major components and the 65 subcomponents. Which ones really matter? And this is where it got pretty interesting. What mattered most and kind of far and away, and to matter, how correlated was it with the Freedom Index, which we know is correlated to GDP and income. And what mattered most, far and away most, was the legal system, property rights. How just is the system? How independent is the court system? Things like that. Business regulation and trade and the ability to trade internationally, freedom was also very high. I thought what was interesting, the two that mattered least was the size of the government and sound money. Sound money is kind of your central bank. So for all the people saying that, oh, the Fed's driving us into socialism, that they're certainly reducing the value of free markets, and we've argued this time and time again that they are a problem for capitalism, but the impact on the Freedom Index is not nearly as much as some of those other kind of core tenets that make countries with high economic freedom somewhat unique. And then, one of the problems that when you look at this Freedom Index and you look at a graph for the world, it was going up for the last 20 years. The last 5 years since COVID, really, economic freedom has been declining. So that again is on average, but that's a problem because we know that GDP per capita and income per capita slides with the Freedom Index. And you look at the United States, our Freedom Index has been declining for the better part of the last 20 years. Not surprising because we have slipped into some socialistic tendencies. At the same time, China's been rising. So they're moving from communism towards some sort of hybrid communism, socialism, capitalism. It's hard to define what they are. Even Russia and Iran have gone into capitalism or moved away from communism at some point. And then lastly, I ask the important question, does wealth buy happiness? And the answer is there's a very high correlation between the happiness index, which who put that out? The World Happiness Report, and the Freedom Index. So yes, wealth buys happiness.
I'm going to disagree with that standpoint, which is freedom doesn't buy, money doesn't buy happiness. It just buys a whole lot of whatever comes in second.
Fair.
I think you can have, I know a lot of really rich people that are absolutely miserable because they don't have, they don't have good family relationships. They don't have, a good stability in their life. They don't have a good economic partner. They don't have, there's a lot of things that they're missing that, also adds to happiness. But having money does buy a lot of whatever comes in second. So, it certainly helps, the situation. If you can remove financial stress from a relationship, it certainly helps contribute to the happiness side of it.
Right. No, we can debate that all day, what buys happiness. But according to the statistics,
yes, this is true.
Prosperity buys happiness.
This is true.
So there it is. Capitalism has been quantified for you, Lance.
There you go. But no, look, it's very interesting. And, we've written articles about, things before. And the bottom line about capitalism, this is the one thing that bothers me more than anything, is that, we talk a lot about housing. And it's like, you have to buy a house. The American dream is buying a house. That's not the American dream. The American dream was never buying a house. That is the representation of the achievement of the American dream, which is in other words, you've come to the country, you have participated in the capitalistic system, you have built some wealth, and now the ability to buy the house is a representation of your ability that you have now achieved that dream. And, but the Real Estate Association, they started pushing this whole idea 20, 30 years ago, is like, oh, you have to buy a house. And so we started looping more and more of, young people into home ownership that they really couldn't afford to buy the house. And because again, buying a house is great to own a house, but along with that comes all the maintenance, the taxes, the upkeep, everything else that happens. And people were getting poorer and poorer because all their money was going into they were house rich, financially broke. And, this creates a whole lot of other problems. And then we started doing all the other kinds of things because of, pushes by the real estate industry to get into adjustable rate mortgages and no money down mortgages and all these other things that grossly exacerbated the price of home ownership. Because again, you had so much, if I can get into a house for zero, it creates excess demand for available supply. And so we've completely broken the relationship between home values and economic growth. Home values used to grow about the rate of inflation every year, but really since the turn of the century, because of all these interventions, very low interest rates, adjustable rate mortgages, zero down, all these type of things, we've vastly exacerbated the price of home ownership to a level that is now become the target of people who are anti-capitalism. But that really doesn't have anything to do with capitalism itself. The function of capitalism, that achievement of building wealth, and you see this every day in people on TikTok as an example. They're building whole businesses off of social media. They're taking advantage of that American dream. They're creating income. They're creating wealth for themselves. Everybody has that ability. You just have to be willing to take the risk of failure, which is the biggest risk you'll take. And just because you start a business doesn't mean you'll be successful. There's a lot of things that go into running a business. About 80% of small businesses fail, but they fail for primarily two reasons. One, they fail because they're undercapitalized to start with. People try to start a business, they don't have the capital to run it for a while. And the second thing is mismanagement of the business. So they start a business and they don't realize that running a small business is going to take 80 to 100 hours a week. It's not going to give you any money for a year or two until you become to the level of success that it's paying its own bills and is able to pay you a salary. So that comes back to the capitalization part. People run out of money trying to build a business and they have to quit. So there's some things that you have to be aware of when you're going to take advantage and start of capitalism and start your business and do those type of things. but it is so worth doing, because once you can create that business, create that opportunity, you also create the ability for unlimited income. That's the big benefit of being independent and employed by yourself, is that you have unlimited income potential. As long as you work for somebody else, your income will always be capped. But once you are the provider of the goods, service, or business or product, your income becomes unlimited. And that is why people strive for that ability. And you can do this. And again, taking advantage of capitalism is not hard. You just have to realize that it also comes with a risk. But again, there's such great stories. Again, we've talked about here on the show the story of the guy that started the Savanna Bananas, completely broke for 3 years, tried to get the Savanna Bananas up and running, and he sold 2 tickets to these baseball games, and came home to his wife and was about to quit, and he said, we're going to have to stop doing this. And she goes, is this what you want to do? And he goes yeah, I really believe in this. And she goes, okay, we're going to sell the house. We're going to go move in this little bitty apartment, and you've got 2 years to make this thing work. And he went and studied Disney. He went and studied every successful type business, and then brought all that knowledge into the Savanna Bananas. Now they're massively successful. My son's so excited they're coming to Texas A&M. He's going to buy tickets. They're like $1,000 a ticket or something. They're very expensive. But this guy created this massive business, almost on failure. Right? Had to sacrifice everything to become successful. But it's a great story. And this is the story about capitalism. And everybody can do it. You just got to be willing to suffer and take that risk to build it. But once you build it, you can build, and again, as you showed before, Mike, on your chart, you can build a lot of wealth. And this is what's happened in the country, is that people that have taken advantage of capitalism have built a lot of wealth.
And Lance, it's not just the owner of the Savanna Bananas that profited.
Yeah.
It's all the people that work at the stadiums. It's those baseball players that were never going to make a living playing baseball. He's created an economy wherever this thing sells out major league stadiums.
Yep.
MLB teams don't sell out major league stadiums. The Savanna Bananas do. So bottom line is, he's creating economy not just for himself, but for many others. And that's the beauty of capitalism, is it just raises everyone. The poor in this country are much better off than the poor in most countries. Look, they're not in great shape. I'm not saying I could, I'd want to live on that kind of money, but they are doing better than the world's poor.
Yeah, exactly. That's what we were saying before. And we don't realize. And again, the thing that bothers me is when people, kind of badmouth capitalism. It's like, oh, capitalism sucks. It's so unfair. Yes, capitalism is unfair. You can either take advantage of it, or it will take advantage of you. And you can fight it. You can not participate in it. You can want for other things like socialism or communism. And that sounds great on the surface. But again, most of the people that are saying that have never lived outside the country. They have never lived in countries that are socialistic or communistic. And you don't realize what you're talking about until you actually go live in these countries that are socialistic, are communistic. There is not equality in those environments. You are either poor or you're rich. There's no in between. And again, there's not this utopia society sitting out there where everybody has the same equality, everybody has the same things, everybody's equal on nature. Capitalism is not about equality of outcomes. It's about equality of opportunity. And capitalism gives you equality of opportunity. The outcome is solely dependent on the opportunity that you take advantage of, and how willing you are to put in the work and the time and the effort to make that opportunity successful.
You seem to care about this topic.
I told you, this is a very important topic for me. Well, only because I've been building businesses my entire life. So, this is a very close topic to heart for me. So,
right.
Any closing thoughts? We'll wrap the show up.
Capitalism rules.
All right. There you have it. 2 words. All right. Be sure you're by the website. Be sure to like and subscribe to the channel. We appreciate it very much. And if you want this copy of the latest article with all of the inherent charts and graphs, etc., that Mike put together, go by the website, realinvestmentadvice.com. It is his article's on the website right now. Simply click on the blogs under resources. It's there for you, realinvestmentadvice.com. Again, like and subscribe to the channel. We appreciate it very much. And we'll see you back here tomorrow for Financial Fitness Friday. And we'll also have a new interview for you in our interview series coming up next week. So got a lot of things coming up ahead of you right here on The Real Investment Show. Have a great day.